What is going on, guys? This lesson is going to be on liquidity. And so, what is liquidity? Well, if you're watching this, you're probably relatively new, you're probably a beginner. And so I like to always just explain things in the way that they make most sense to me and other people and that are easy to really understand. And so to me, liquidity is our resting orders that need to be filled, right? And so they lie in swing highs and swing lows. And so, natural movement of price, what does it look like? Bearish price action looks like this, right? What does bearish price action look like? Well, it looks like this. And so price never just moves in a linear line, never. And it's never like that, right? It's made up of highs and lows, right? And so if we look right here at this bullish price action, right? This is a bullish chart. You'll see here that with every swing low, we are creating sell side liquidity. And so what that means is that when you are in bullish order flow, when price is in a bullish trend, you are typically generating a lot of liquidity below. You're generating sell side liquidity. And why is that? Well, it's because buyers are putting their stop losses at those swing lows, right? So if I'm taking a buy position anywhere down here, I'm going to be putting my stop loss, at this low. If I'm taking a buy position around here, I'm putting my stop loss at this low. If I'm taking a buy position around here, I'm putting my stop loss at this low. And so that creates liquidity because the people in the markets are putting their stop losses at those swing highs and swing lows, in this case, swing lows. And so with that being said, you can expect price to then trade back to these lows, right? But in a very simple sense, what you need to understand is that liquidity serves a purpose of creating, let's say, like a mandatory reason for price to trade back to a level because orders need to be filled there. And so that being said, right, people who are longing the market, since they're setting their stop losses at these lows, there is now money waiting to be grabbed, sitting at that area, sitting at those lows. And eventually, price will then trade back to those lows if they get left behind like that. Same applies for bearish order flow. If you're looking at a bearish chart, it looks like this, most likely, right? It goes high, low, lower high, lower low, lower high, lower low, lower high, lower low. And in this move, you are generating a lot of buy side liquidity. And so what that means is there's stop losses resting at these levels. If you're taking shorts from like around here, you're going to have people putting their stop losses, right, at this high. If you're shorting around here, you're going to have people putting their stop losses at this high. If you're going to have people shorting here, you're going to have people putting stop losses at this high, and etc. And you get the point. And so that's money waiting to be grabbed. And so why you need to understand liquidity is because if you understand where liquidity lies, then it helps you avoid being liquidity itself in the markets, like truly, because price usually will sweep liquidity before it then delivers in the direction it is supposed to deliver to. And so let's say you look at something like this, right? We're in a very bearish chart, right? What you'll notice is a lot of people, right, they want to buy low. They want to buy low, sell high. That's the whole gist of things. But you don't want to be early either, right? And so you want to wait for liquidity to be taken before the real move is initiated. So, right, learning to identify where liquidity lies is how you learn to not become liquidity, right? So if we have this very bearish move and we create this low down here and people start seeing, oh, well, price is trading higher, this surely is, the bottom of the move. Let's take longs and I'm going to put my stop loss at this low, right? And so they're thinking, okay, I'm going to go along here and put my stop loss at this low. Well, what is happening? We just left liquidity at that low. And so what people don't realize is that you need to wait for this liquidity to be taken before you enter a position. And so you'll notice the price will come down, sweep this liquidity, and then this real move is initiated, right? So that's usually how price moves the majority of the time, right? If you are in very, very bearish order flow, if price is very bullish, bearish. I meant if price is very bullish in the sense, right? Let me mark it out so we don't get confused, right? Right here you have bearish, and right here you have bullish, in the sense where it's like we're bearish at first, here we're bullish at first. And so before we want to enter a short position, we want to wait for liquidity to be taken. And so, right, people here, they see this move and they're like, okay, I'm going to start shorting here because price is now coming down. Surely this is, you know, the top and I'm going to catch a good short and all this. But what they're not realizing is that, well, they're just putting their stop losses at liquidity. And so what's going to happen is that because there's liquidity not resting at their stop losses, there's a very high chance that they're going to get manipulated out of that trade and stopped out, right? And so this high right here becomes liquidity because there are plenty of resting stop losses there, and price will hunt those stop losses before it then moves in the direction it wants. And so being able to identify liquidity is what helps you avoid being liquidity. And so if we're just looking at a chart in general, right, like a just chart, you'll like a just chart, what will you realize? Okay, well, if you have a high and a low, you know, there's liquidity on both sides, of course. And so we can mark that out. Bang, bang, bang. Boom. And so let's say we expect price to trade to this high. Well, if we expect price to trade to this high because there's liquidity lying there, first we want to wait for liquidity to be taken on the bottom. And so ideally, we would wait for something like this. Okay, price trades lower, takes this liquidity, and now it will go for this liquidity, right? And this sequence of events can happen vice versa. This can actually be something like this. Price takes this high first, and after it takes this high, what do we expect to happen now? Price is going to go to this low. And now what's going to happen? Now it's going to go to this high, and then it's going to go to this low, and now it's going to go to this high, and then this low, and this high, and this low, and this high. Do you get what I'm saying now? And so that's the way price moves. Price seeks liquidity, okay? So notice what happens here. We create a high, we create a low. We then sweep the liquidity in this high. And so what happens when we sweep that liquidity right there is that we also create liquidity here. And now price goes to this low, sweeps this liquidity right here, and now we create liquidity down here, right? And then what happens? Price trades higher, sweeps this liquidity, price trades lower. Now we have liquidity here. And so there's always going to be liquidity resting at these swing highs and swing lows. So being able to identify them is crucial because it helps you understand where price is going to go to next, right? It's very simple, or at least I hope it's simple. And there's many different types of liquidity, but I'll get into that in the next video. But as long as you understand that liquidity is sitting at those swing highs and swing lows, and price will always seek liquidity, it'll help you understand the overall movement of price. And so, I mean, let's look at, I guess, a chart for example. So we have, you know, highs right here. We have some high right here. We have a high right here. Whatever. We always have highs and lows. That's just naturally how price is. And so what you'll realize is that price has been very bearish, right? Price has been very bearish. And eventually, you know, we have these lows here as well. And before price decides to flip bullish, what happens is that we sweep some liquidity. So we have all this liquidity up here. And look what happens right before price flips bullish. It sweeps some liquidity below, right? It sweeps the sell side, and now the move up is initiated. What happens here? We create liquidity right here as well. Here, price sweeps this low, bang, and now trades higher. Do you get what I'm saying now? And so this is always happening, right? Notice what happens here. We create a low, price sweeps this low, and so what is it going to target, right? Okay, let's look at it this way. We have liquidity up here. Let's even pull back the charts like this. So let's try to mark out our significant highs and lows here, right? We have this move that's initiated, and so we now create liquidity up here and liquidity down here, right? And so what happens is that price then, as you'll see, price traded lower, swept this liquidity, and then ran to the next liquidity level up here. And then what happens once again? Price, after sweeping this liquidity up here, price comes down, sweeps this liquidity, and then once again runs back up and then sweeps this liquidity, right? So you can see that this is always happening, right? Price is always looking to sweep liquidity, and then from there, more moves are initiated. And so really all you need to know about liquidity is that they're resting at swing highs and swing lows, and you will often see that price moves like this, right? You want to be able to identify your significant swing highs and lows. And so you can see here, we get a swing high, liquidity rests here, swing low, liquidity rests here. What happens? Price goes up, sweeps this high, price goes lower, sweeps this low, price goes high, sweeps this high, price goes lower, sweeps this low. And so price is always looking to sweep liquidity. And it's very important to understand, like I said, because it helps you avoid being liquidity. So yeah, in a bullish trend, you'll often see a generation of a lot of liquidity within these lows. And in a bearish trend, you'll often see a large accumulation of liquidity within these swing highs. So before you enter some sort of long position, you want to wait for something like this. Bang. And so price sweeps that liquidity down here. And now, you're good to be longing. And same for here, right? Before you were to enter a short position, you'd want to see some buy side or some just liquidity in general be swept, and then the real move is initiated. And so that's really all you need to know about foundationally for liquidity. So hope that made sense.